This is Retire Hour.
Well, hello everyone. Welcome into Retire Hour. I'm Matt Goolsby. Today I want to take you back in time to the 1980s. Not here in the United States, but across the Pacific Ocean in Japan. Back then, Japan was an economic powerhouse. Its companies were leading in cars, electronics, and technology. Japan's stock market was soaring, and their real estate market was hotter than ever. People believed that Japan might even surpass the United States as the world's #1 economy. But something happened. Something that serves as a cautionary tale for us today. And as we look at our own markets at all-time highs, our own money supply at historic levels, and the Federal Reserve is signaling they may cut interest rates, let's explore what happened to Japan and what lessons we can learn for maybe your retirement nest egg. Well, Japan had a boom in the 1980s, like I was saying. Its growth story really kicked into high gear. After decades of rebuilding from World War II, Japanese companies were Japanese companies were the world's leaders. The country ran a trade surplus with the United States and Europe. The yen, their currency, was strong, exports were strong, and optimism was everywhere. But in 1985, the Plaza Accord was signed. Now, this was an agreement between the U.S. and Japan and a few European countries to basically bring down the value of the U.S. dollar. The U.S. was struggling with trade deficits, and this deal made the Japanese yen surge higher in value. That made Japanese exports more expensive, and the economy began to slow. So what did the Bank of Japan do? It slashed interest rates. Credit became cheap. Banks flooded the system with money, and the money supply, what economists oftentimes refer to as the M2, it took off. All that easy money had to go somewhere, and it did. It went into the stock market in some ways, and the real estate market. Tokyo real estate prices skyrocketed. Their stock market index surged to an all-time high by the end of the decade, and speculation was everywhere. People believed land prices would never go down. Is any of this maybe sounding familiar? But the bubble doesn't last forever. By the late 1980s, inflation was rising. The Bank of Japan realized things were getting out of control, and they reversed course. They raised interest rates sharply, and that was the pin that popped the bubble. Their stock index collapsed, losing more than 60% of the value in just a few days. Real estate prices fell dramatically, wiping out billions of dollars in wealth. And the aftermath was devastating. Banks, they were left with bad loans. Companies, they struggled. Consumers pulled back. And Japan entered what we now call the lost decade. Actually, it could be lost decades, because there was years of stagnation, deflation, and slow growth that stretched on and on. Even today, more than 30 years later, Japan's stock market has only just recently began to approach those highs from the late 80s. Imagine that. 3 decades of waiting just to break even. And that period I'm referring to is 1989 to 2024. Now we got to look at the parallels in our own country. Let's fast forward to today, the United States, 2025. Our stock market at all-time highs. Real estate prices, while cooling in some areas, are still pretty elevated. The M2 money supply, meaning all the cash and checking accounts, liquid money in the system, it's still at historic levels after the surge we saw during COVID and all that stimulus. And what's the Federal Reserve signaling? Rate cuts. Think about that for a moment. Japan cut rates in 1980 or 1980s to stimulate its economy, and it created a bubble. Then when inflation forced them to raise rates, the bubble collapsed. Here in the U.S., we've already had near zero rates for over a decade. Then we have record stimulus during the pandemic that fueled asset prices, stocks, housing, and now with inflation not fully defeated, the Fed is talking about cutting rates again. And could that inflate another bubble? And if so, what's going to happen when or if it bursts? You might be thinking, Matt, this is an interesting story, or this is interesting history, but what does it mean for me and my retirement? Well, here's the reality. If Japan's story tells us anything, it's that markets don't always go straight up in a line. Sometimes they don't recover for decades. And if your retirement plan is only built on the assumption that the market will always bail you out, you may be setting yourself up for disappointment or worse. Imagine retiring in 1989 in Japan. You thought you had it made. Your stock portfolio was worth a fortune. Your real estate was through the roof. And then within a few years, half your wealth was gone. And in some ways, it took forever to fully come back. And in some ways, maybe it didn't come back. Remember I said from 1989 to 2024, lost decades. The danger of not having a coordinated plan, because retirement isn't about riding the highs. It's about having a plan for the unexpected. You think Japan was expecting their downturn in the booming 80s? I don't. So what lessons do we have to learn? What can we draw from this for today? First, easy money creates bubbles. When the Federal Reserve pumps liquidity and lowers rates, it feels good in the short run, but it often creates distortions that eventually have to correct. Second, markets can take very long to recover. Japan shows us that the just hang in there mentality didn't always work. If you're in your 60s and retiring and you don't have 30 years to wait for the market to come back, what's your plan? Third, demographics matter. Japan, they faced an aging population. Another way to say that is maybe a shrinking workforce in the 1990s all the way into the 2000s. Is any of this, again, sounding familiar? Because the United States, we have an aging problem too. And as more people retire and fewer people replace them in the workforce, growth slows, government spending surges on entitlements. This sounds familiar, right? Fourth, high debt makes the problem worse. Japan's government's debt exploded as it tried stimulus after stimulus to revive the growth. The U.S. today already has its debt at levels we've never seen in peacetime. And that limits the flexibility when the next financial crisis comes. So what can you do? Well, so what you can do as a retiree or someone approaching retirement is, number one, diversify your plan. Don't maybe just solely rely on the stock market alone. Think about income sources, tax strategies, estate planning, and your healthcare costs. Number two, stress test your plan. What if the market drops 30%? What if interest rates stay low and bond yields don't deliver? Do you still have enough income to cover your needs in retirement? Number three, coordinate your advisors. And this is where our Core 4 report process comes in. Retirement, it's not just about the investments. It's about retirement income, your estate plan, your healthcare options, including Medicare, and of course, taxes. Each of those pieces, they interact. And if you don't coordinate them, you may be exposed to risks you didn't even realize. So Japan's retirees in the 1990s learned the hard way that wealth can evaporate quickly. So don't let that be you. Reach out and give us a call at 833-44-CORE-4. You can schedule that 15-minute conversation with us and make sure you've got a plan, because I hope the economy keeps plugging along, but there's some things out there that are starting to concern me. And I know we're in kind of the uncharted territory as history goes, but you need to have that plan. Stay tuned. We'll be right back with more right after this. Welcome back into Retire Hour. We're going to bring in an advisor here, Doug Miller from Wichita. You know, Doug, you have been working with this client, you said, for about 6 months, right?
Yes, Steve, newish client.
Newish.
Yeah.
Hasn't
6 months.
6 months, yeah. Okay.
We haven't been through a full cycle.
Haven't done his taxes yet. Getting ready to do tax planning for him. But, you know, like you said, he's kind of coming on board. What was going on in Steve's situation?
Well, Steve has been trying to retire for a long time. So he's finally getting there. He's finally, okay, this is my year. And amongst a bunch of other assets, he's got a company 401k. That's kind of his big asset. But unfortunately, he had put his money in a target fund. Now, the target fund, I know you're familiar with them, but for those who are not, target funds are aimed at a certain timing. He initially wanted to retire in 2020. So his target fund is aimed at 2020 when he thought he would retire. Unfortunately, due to the way target funds work, they become more conservative as you get closer to the retirement time. So as this had expired, his fund had actually become so conservative, it was losing money, and the only gains was the salary he was putting in.
Well, I can see the logic in a target fund. It's like, oh, well, I don't have to pick the investments and it just does it for me on autopilot. But as you started to show him the devil in the details, the proof in the pudding, so to speak, and charted that for him, what was kind of the, don't get into specific performances, but it had lost money, right, over the past 4 or 5 years? It
had, and it didn't. So you looked at the loss was kind of covered up by his salary. He was just kind of looking at the bottom line, as many people do. You get this paper statement and you look at the bottom line, and it's bigger than it was last quarter, and you're like, okay, I guess it's going in the right direction. But when you dug in deeper, you found that the bond funds are different from bonds. So I don't want to get too inside baseball.
That's true. That's true.
But he had found that as he'd gotten closer, the fund is managed. So as you got closer to retirement time, there was more bonds and less stock. So he was now 100% in a bond fund that actually had been losing a little bit of money each year, but he couldn't see it because it was covered up by his salary.
So what I'm hearing is you took his investments, and this is our industry has its own jargon. I'm sure his industry, Steve's industry, has its own jargon. You have all these technical details, all the specifics where a normal retiree doesn't understand what's going on, and you put it in plain English for him.
Absolutely. I mean, we put it up. We put a chart up, and we said, here's the breakdown, and we basically had a little line on a graph. Here's what the S&P has done, and here's where the bonds went. And the bonds had been kind of straight, and they'd kind of gone over to the right, but down a little, not up and to the right, which is what we like.
And you were mentioning earlier, really the only increase in value in his account was his own contributions going in, and he didn't have any idea what was happening with his target fund.
Yeah, and like a lot of people, target funds they've been around for a while, and they're a one size fits all. It's very easy for someone over the phone to say, here's a great solution, and it sounds like a good pitch. But again, the weak point in the Achilles heel on these things is the bond funds.
So what if these target funds, they go in 5-year increments? What if you're not going to retire on that 5th-year increment too? I mean, this is a one-size-fits-all strategy in my opinion, and that's not really good when it comes to your retirement plan.
No, exactly. You can get better. You can get the equal safety. So they're designed for safety. They're designed because people, losing money is more painful than making money to many people. So they're conservative because the big money managers don't want you to be calling them up and say, hey, I've lost money. So they would rather you have a less appreciation. But you do have to balance with client safety.
So back to these dates, the 2020, I've walked people through and charted this and showed them how these funds perform, and they go, like I was mentioning, in 5-year increments. But I'm sure Steve was surprised. Did you chart alongside his 2020 target fund, or did you chart like a 2040 or a 2050? That's the ones I really like to do, because it shows those target funds, they'll take a dip, but if your date is close, you don't really recover from the dips. You just kind of now have a little bit of lower bounce. But the further out, like 2040, 2050, sometimes they don't even do very well as far as this one-size-fits-all plan.
Yeah. I mean, the 2030s and 2040s do better compared to a 2020, which is now 100% bonds, but compared to something like the stock market, the S&P 500, they very much underperform, and you can see it with lines, don't want to get into numbers, but you can see it with lines on a chart. You can see the little line going up, but not quite up and to the right. Whereas, the S&P, and the S&P has its risks, so we don't don't put everything all your eggs in that one basket. Yeah, but it can be a great driver.
So Steve, obviously his eyes were open to the fact that while he was working and contributing in his 401k, maybe he didn't think he had any other options. But what was the outcome here? How did you walk Steve through our process?
Well, Steve's going to come. Steve's retiring very soon, so we're moving his fund, his 401k, over to an IRA, his own retirement account. That's where we can take out we can replace the bond funds with something that's going to have equal amount of safety, so it can have zero loss or zero loss, but it also can appreciate some as well. So he can also make some money. And we balance that out with his risk. And so we have these chats with him.
You and I typically will prefer bond alternatives, we call them, instead of using a bond. If you can get, if the plan can work that way, not everyone's plan does, but if you can swap out the bonds that can be volatile when they're changing interest rates around, it can help complement maybe an aggressive stock portfolio. And like you said, putting different eggs in different baskets for different purposes. I'm glad that you were able to walk Steve through that plan there. And of course, he's going to go for another 6 months, right? He's not just going to work with you for 6 months.
Oh, we've got a long-term plan. So yeah, Steve and I have. Steve now has faith. He's like, okay, I understand where I was underperforming, and we've shown him a way to get a better performance and equal safety. So one of these other things I always say in meetings is like, sleeping at night never shows up on a spreadsheet.
It doesn't.
So as long as he's sleeping at night and he's making money and he's got everything his needs taken care of, then we're in a good place, and we are.
And guys, if you're out there listening to this and thinking to yourself, man, I need a plan, or I think I'm invested in target funds, you're saying they might not be right for me, reach out and schedule a 15-minute chat with us by phone. That's step one of our Core 4 report process. And you can do that by calling 833-44-CORE-4, or that's 833-442-6734. Or you can go on over to our website at retirementhelp.com, and you can book that 15-minute call with us, or 15-minute Teams meeting or Zoom, however you want to meet, and we can understand your situation a little more and tell you if you can benefit from going through this full Core 4 report process. Well, stay tuned. We'll be right back with more Retire Hour right after this. We're back to Retire Hour here, chatting with Doug. I was just asking Doug Miller here, one of our advisors in Wichita, what happens when someone that you're meeting with, whether it's a new client or someone that came to our classes or they've been listening to us on the radio show, as a financial advisor, what happens when someone comes to you and say, well, what's this going to do to my taxes?
Well, the natural male instinct is to give an authoritative answer, even if I'm only half certain. Luckily, I've kind of grown out of that technique, and I will reach out to one of the in-house CPAs, so either Lauren or Joshua, ask them about it. But we also, as well as reassuring them that we have the skill set in-house to answer their questions, when we have new clients on board, part of the service we offer to all clients is a tax planning session towards the end of the year. So I also ask, is there any immediate need? Have you had a life change? Are you just going along, you're still working, or you're retired, everything's settled, or are you coming up to retirement? Is there something going on in your life that we need immediate tax response or insight? At which point I can usually get Lauren or Joshua to come over. And
speaking of Lauren, we're going to have her on the show. Josh was out this episode, but Lauren is going to talk about how the One Big Beautiful Bill has these senior bonus deductions in it for people that are over the age of 65 or will be at least 65 by December 31st of this year. They're going to get that extra $6,000 potentially bonus deduction. If they're married, they can double that. This is going to have an impact on tax planning for Roth conversions, wouldn't you say?
Oh, absolutely. I mean, I'm a big fan of the Roth conversion. To me, it's like home base. It's finally where you've got your money. Once it's there, it grows tax-free. It comes out tax-free. It's not counted as income. This is probably one of the best deals that the IRS and the government offers. But again, this is saying, preach. I think it's a great product. But again, Lauren will come in and give us the details on how much you can put in, because there's different ways to get money into Roth conversions.
In Roth?
Yes.
Yeah, Roth.
I gave away the answer there.
That's all right. There's that's Roth conversions. One of them. But how does a financial advisor like yourself help their clients with these Roth conversions if they're not getting tax advice? Or if they don't have a tax professional they can pull in the conference room or in the meeting with that person?
Well, generally, if they haven't got a tax professional, usually they've come to me at the beginning. So we take a look at the whole portfolio of what we've got. We map it out on forms. We look at where their income comes from. Are they still working? Have they got Social Security? Have they got other pensions? Have they got other forms of income? Many people have little, what I call side hustles. They have property, a little bit of rent. Maybe it's coming from wherever. They have different kinds of income. So we map that out. And then we take a look at the plan, and we also see what age there are, because there's a lot of variables as to whether the, as you say, one size fits all doesn't always work. So the idea of just going to a Roth conversion is great, but it might not be great this year. It might be next year's best solution. And again, I will look around, I'll map everything out, and then we'll get Lauren in to give us the green light or a confirmation that maybe the next year would be a better plan relative to their tax bracket.
Where I find those is, and I've said this before, I think the retirement system in America is broken. And why I say that is, if you're a retiree, you go to your financial advisor. They're normally the ones that's probably meeting with the people the most in retirement. Hopefully, you're meeting with your financial advisor. But then that financial advisor can't help you with the tax issues, like we just talked about, Roth conversions, how to maximize this extra senior bonus deduction if you're over the age of 65. But then it's like estate planning questions or maybe even elder law questions. Because the other day, when I'm going to talk about this on the TV show this week, I had a husband and wife come in, and they've been clients of mine for 2 years now. But one time the husband didn't come in, and he'd had an accident.
Oops.
He fell off a ladder and had quite a bit of loss of blood, and she was worried that she might have to put him in a facility if he didn't get better. Well, good news is he got better, but in that moment, well, let's call her Susan. Susan had questions about Medicaid spend down, and I'm a financial advisor. Yeah, we can Google things. Is that really probably? Do you want your doctor saying, hang on, we're in the middle of this brain surgery. I have not done this before. Let me Google this and see how to. That's not what you probably want.
No.
You want a brain surgeon to operate on your brain. You don't want a doctor Googling or using AI or figuring all that out. But this Medicaid spend down, I was able to go down the hall, grab one of the estate planning attorneys, come in, continue that conversation in real time. And she actually would qualify already for, their situation would already qualify for Medicaid. Fortunately, though, he didn't need it. But again, we get, as the financial advisors, we're getting a lot of questions asked of us that we're not really equipped to deal with.
No, that's absolutely right. And luckily for us in this situation, we have people literally next door. I've literally been in a meeting and I've literally shouted, Trey, can you come in?
Trey's a Medicare advisor.
Trey's the Medicare advisor, yes, not the CPA, but we have people close. So obviously, I'm sure it's happened to some financial advisors. You look there, you don't want to be seen not to answer a question. You hit a quick Google, and then you give an authoritative answer, which may or may not be right. But it is, yes, we have expertise in-house, which is one of our benefits.
Whenever I take a trip, I don't have to go in there and ask the pilot, is this really your job? Do you know how to do this? They're certified. That's what they do every day, day in, day out. But you got to ask yourself, if you're listening to this or watching this week, do you have a professional team that you can rely on, whether getting ready for retirement or getting ready to transition into retirement, or maybe you've been retired for years? It doesn't matter. All these issues can hit you from out of the blue and, worse yet, cost you thousands of dollars. But it doesn't have to be that way. Schedule your 15-minute introductory call with us today. You can do that by calling 833-44-CORE4. That number again, 833-44-CORE4. Or you can go on over to the website at retirementhelp.com and schedule that first step, that introductory call with us, and figure out if you're a good candidate to go through our full-blown process. Stay tuned. We'll be right back with more right after this. Well, I don't know about you guys, but I'm really enjoying the weather lately. This cool off, this fall, I think fall is on its way. But whenever I think about fall being on its way, for some reason I think about Medicare. Why would I want to think about Medicare going into the fall?
I don't think you're the only one, Matt. Why do people start thinking about that?
It's that annual enrollment period, isn't it? I mean, you guys are the calm before the storm here. It's kind of like your tax season, so to speak. And 1st of October, your calendar's booked almost until December 7th. I was looking at it the other day. You are busy. But there's all these acronyms and letters when it comes time for Medicare: HMO, PPO, DSNP, Part B, Plan G. There's all these different terminologies that I'm a financial advisor. I got my own crap to worry about in my own lane. You and your team help the people we meet with all these healthcare questions, and I'm glad you guys do that, because some of this stuff I don't even know.
Yeah, it's quite a lot to take in whenever you are looking at Medicare. I was sitting with someone from the medical field the other day, and they were asking me questions about Medicare and the health insurance, and it dawned on me because I'm explaining this to someone who went through all these years of medical school, and they go, "Why is this program so confusing?" And this person who's obviously a very bright individual, we have people that are 65 years old who have been working in all different backgrounds of life, and they're stepping in, and now most of them don't start to think about it until they're 64, maybe even 64 and a half. And now it's a whole drinking from a fire hose.
And that's a good way to put it, because there's kind of two versions of Medicare, right? Medicare Supplement, Medicare Advantage, and then you've got the drug plan you got to add in there as well. You could be in the healthcare industry and maybe have some idea of some things about Medicare, but that's probably not their niche. They probably need to go to someone like you, Trey, Taylor, Presley. I could go on, Drew, Dan. I miss any?
Yeah, we got quite the team here.
Well, I was going to say, to leave out any of your kids there. So, but they help people walk through their situation and figure out how they're going to get covered best by Medicare, not Medicaid. And they have to. They're a big help in helping people understand HMO, PPO, DSNP, Plan G, Plan B, LMNOP.
Yeah, absolutely, Matt. Our first couple sit-downs with a client, we like to put it all out on the table. We like to ask them, what do you currently know about Medicare? Who have you been talking to about Medicare thus far, to understand what kind of base knowledge we're coming in with? And then we want to follow that up with a good learning period, because at the end of the day, we're not somebody that's here trying to get someone to sign up for any one product over another. It's all about an individual circumstance, and really what we want to do, because we're qualified to work all of these different lines of Medicare, is to let an individual know what options they have out there on the market.
But I think that's a good point. I want to circle back around to that. There are some people out there that don't offer both sides of Medicare. They maybe use their own personal bias to say, no, I'm going to push everyone to a Medicare Advantage plan. That's not the right thing to do. Or I'm going to push everything to a Medicare supplement, and that's not the thing to do either. It's really your guys' job, and you do a very good job at it, walking people through the ramifications of going one way or another, or maybe just they want covered just like they've been covered at work. And sometimes with Medicare Advantage, they're used to a plan that has to have prior authorizations, and they don't care. But some people that haven't been used to that, maybe they want to supplement, and you guys do an excellent job of walking people through those differences in the plans.
Yeah, absolutely, Matt. And whenever we meet with a new client, this is sometimes tough to do, because as they approach Medicare age, they're getting it from all different sides. They're having friends and family members telling them that they need to do this. They got a phone call telling them they need to do this, and they come in with a new packet that says they need to sign up for that. But whenever we sit down with somebody, we always try to encourage them to keep an open mind as we start to take a look at Medicare. We're not saying that you need to go with this product or you need to go with that product, but we encourage everybody to have a good understanding of what the different systems are.
And when you walk people through this, what are some of the things they need to bring in so they can have a productive conversation with you?
Yeah, absolutely. So as we start to take a look at Medicare and exploring how Medicare works with the individual, the major factors at play are going to be, what doctors do you currently see? Who is providing that health care to you, and kind of mapping out what your health history has been. Along with that, we want to take a look at prescription drugs, because we're buying insurance that's going to cover very specifically the drugs that you are taking. And Matt, this is one spot where I believe we go a little bit above and beyond compared to other places. We actually ask people about their family health history, and we will take time to understand, how is their parents' health? Is there any predisposed
Does cancer run in the family?
Exactly.
Does heart
the
issues
big
run in the
questions
family?
like that.
I mean, what are your risks as far as from a health standpoint?
Absolutely, because we don't want people to. With insurance, it's always a game. You want insurance to pay more money, and insurance wants you to pay more money. We want to set people up and position them as well as we possibly can to ultimately win that insurance battle and have insurance pay them more money than they pay in.
Well, that would be great if it worked that way all the time.
If it worked that way all the time. Insurance is one thing that we do purchase. I've yet to be proven wrong. We do purchase hoping that we never have to use it. But ultimately grateful whenever we do.
When we need it, it better be there, right?
Absolutely.
And so if you guys are thinking to yourself out there, man, I'm on Medicare and I don't know how my Medicare plan could be changing for me next year, or maybe you're not on Medicare yet and you're getting ready to be on Medicare and you have questions about your situation. Either way, you can get answers by scheduling that 15-minute phone conversation and start your journey. Remember, that's step 1 of our Core 4 report process. And you can schedule that 15-minute call by calling 833-44-CORE4. That number again is 833-442-6734. Or you can hop on over to the website at retirementhelp.com and book that 15-minute chat with someone from our team to figure out if you can benefit from going through the full-blown process. Well, stay tuned. We'll be right back with lead estate planning attorney Gerald Eidelman talking about outrageous and eye-opening estate planning stories. Stay tuned. We'll be right back. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. I'm Matt Goolsby, and as a financial advisor, I get asked all the time, do I need a will? Or do I need a trust? Or, we've been thinking about doing an estate plan. We don't really have anything. That's my best voice.
Any voice.
But Gerald Eidelman here with Eidelman Law Firm, you're going to share with us some crazy stories here.
Yes.
What do you got?
Well, I'm hoping that by sharing these crazy stories, people understand the significance of not planning. I mean, clearly this is not going to be your life, but understanding the consequences of not planning is rather important to get your feet moving to do something about it. And to begin with, let's talk about Prince.
Oh yeah, Prince,
the beloved Prince,
the musician, singer.
He left nothing in place.
Yeah.
He had a fortune of $300 million. His family and his estate and everything else spent over $9 million to settle the estate, and it took 6 years.
I was going to say, isn't it 6 or 7 years? Okay, so yeah,
Yep.
that I do remember that story. So 6 years tied up in probate, that's got to be cheap.
Oh, yeah. Well, it's not as bad as Elvis.
Oh.
Elvis didn't leave anything as well.
Oh.
And there was a lot of problems with who was managing. Elvis' estate actually lost, and it took 12 years to probate, and it lost 73% of its original value. Michael Jackson's.
Yeah, you got all these singers. It sounds like singers are terrible estate planners.
Well, I mean, it's true. I mean, there's a lot of them in the list that I can go on. I mean, Michael Jackson was worth $2.5 billion at the time of his death.
With a B, billion.
With a B, which is it's significant amount of money, even today's dollars. And the state took almost. It didn't get settled, and he died in 2009. Didn't get settled until about 3 or 4 years ago, finally. The state is still ongoing under the supervision of the court. Now, thankfully for the heirs of the heirs of Michael Jackson, his estate continues to make money. In 2026, it made $825 million.
2026? Are you reading the
I'm sorry,
future here?
2016. Oops. Well, I'm getting ahead of myself. I know the future.
Tell me. But so in 2016, you said it took how many years?
Well, and it took approximately, died in 2009. It didn't get settled sometime until 2016, so we're talking 7 years. And again, it's not closed. The state is still open and being supervised by the court still. And so legal fees are ongoing. Trustee fees are ongoing. Now, here's the trick. Michael Jackson had a trust, but he never funded it.
Well, we see that happen
a lot
because I think, again, I mentioned this earlier, I think the retirement system in America is broken. It puts all the responsibility on the retiree's shoulder. And yeah, you could go out and have that trust created. You could get the best estate plan you've ever seen. But if you don't make sure it's going to be there to go into force, retitle accounts, maybe put it in the trust name, transfer real estate, make sure the beneficiaries of the trust. These are all important steps that sometimes people don't follow through on.
That's right.
And I think it's just because they don't know they don't understand they have to.
Right, and if you don't do it, then you're left with either a will that you drafted, which usually they do when they do a trust, or no will, and then loss of intestacy, and which is the law the state sets up to the transfer of assets for a deceased person. So it's very easy to overlook that and then have all these papers that, like in Michael Jackson's case, meant nothing.
Yeah. You can have the pretty papers, but if it's not set up correctly, it's not going to kick in and do what you think it's going to do. And here's a news flash. I talk about this in our estate planning class. You won't be here when your estate plan kicks in.
That is exactly right. Now, I want to give one last story, I think, for those people who are not married. The author of The Girl with the Dragon Tattoo died suddenly.
Yeah.
Did not leave any estate. He was living with another individual.
Oh.
That individual got nothing of his estate.
Wow.
It went to his estranged father and his son. Why? Because he didn't have a will. If you are not legally married, or you don't have some sort of will or trust appointing that person to receive your assets, they will have no part of your estate.
I'm looking up John Wayne because I think John Wayne's estate, it ran on for a long time.
Oh, yes, it did. Again, it's amazing how many years it lasted and how much money gets lost in the process. I mean, like 73% of the value of Elvis' estate was just went up in smoke.
That's a hunk of burning love.
Yeah, that's right. Yeah.
I couldn't resist myself. I'm sorry. Well, John Wayne's estate, if I'm remembering this correctly, he passed away in June of 1979. And I think his estate stayed open for a long, long time. But basically, they stopped. The probate process stopped, and everyone agreed and wrapped up when it was out of money.
Yeah.
And that's not what anyone wants to do.
No, and again, these seems outrageous stories, but they can happen in your life, even though you may not be a famous star. These things are examples of what can happen if you don't plan, if you don't work with a team like us, who can advise you both about your estate plan, your financial situation, your retirement plans, and those things that play a huge role in setting up your estate for the future of your spouses.
And a lot of times we'll find that people that are out there, that you have all these different professionals, whether it's a financial advisor, a tax advisor, your Medicare guy or gal, and then your estate plan. If they're not all working together, it's your responsibility to coordinate all those people. And a lot of people I talk to say, well, we just retired. We don't want a new job. And if you don't have a team that can help you, reach out and schedule a 15-minute chat with us by phone by calling 833-44-CORE4. That number again is 833-442-6734. Or you can hop on over to the website at retirementhelp.com. We'd love to schedule that 15-minute chat with you by phone to help you understand, are there any gaps out there in your retirement plan? Well, speaking of retirement plans, we're going to be right back with Lauren Dietz of Market Tax Services having a conversation with me about this one big, beautiful bill and this bonus senior deduction. Stay tuned. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. I'm your host, Matt Goolsby, and we got Lauren Dietz in here. You're much prettier than Joshua. You know that?
Oh, thanks. I wore better shoes than him, too.
Well, yeah, he's got, I call them his Liberace shoes. They all sparkly. But...
I know. I've got the spiky counterparts.
Oh, the female equivalent. All right. Well, you and I and Joshua, we've been already starting to kind of gently wade into tax planning season. You and I are going to talk on TV this week about a couple that Joshua said don't do a Roth conversion with,
right,
because they were maybe wanting to itemize their medical expenses. This one big beautiful bill, I'm teaching in these classes. Some people still think that Social Security is not taxed,
Right.
and that's not the case.
That is not the case.
They had to come up with this compromise, this
Yes.
senior bonus deduction. So I see in your notes there, you're saying OBB is not a Secure Act 3.0?
It's not. It's not. But there are some good opportunities there for tax planning in the OBBBA or OB3, whatever you like to call it. I think OB3 kind of reminds me of like C-3PO from Star Wars. And
I think that's why
and I
Joshua
kind of like
likes
it.
Yeah, I think that's why Joshua likes saying it that way, because he's a big Star Wars fan.
Yeah. So I mean, there was some good opportunities where they didn't change the tax brackets back to what we were thinking they were going to go to. So this is good. This gives us more time to do some cheaper tax planning for people.
And what does cheaper tax planning mean?
So instead of your 12% bracket moving up to a 15% bracket and so on and so forth through all of the tax brackets,
Right.
We still have those lower rates. Those were made
Well,
permanent.
yeah, I mean, they will never change again. They are permanent.
They are, yes, permanent with big quotation marks.
They are permanent until the next government, president,
Decides
Congress
to change their
it.
mind. Yes,
So
yes.
don't get lulled to sleep by permanent.
Right. I think it's like the time is now. If you've got the opportunities now, let's do it now versus waiting 5 years, because who knows, 5 years from now, we could have a totally different set of people in government, and I have a feeling that there's probably going to be some different bills that get proposed.
And we'll talk about in our tax classes about how if you have a retirement, an IRA, 401k, it's almost like that's an adjustable rate mortgage. Hear me out.
Okay.
If you're going to go buy a house, do you want a fixed rate mortgage or do you want an adjustable rate mortgage?
Personally, I like fixed rate.
Why do you like fixed rate?
I like fixed rate because I got in at a really, really low rate mortgage, so I don't ever want that to change.
So you're really happy with your rate.
I'm really happy.
But if you have an adjustable rate mortgage, that rate can go up over time and cost you more money, right?
Right.
And had you had an adjustable rate mortgage, you'd be paying a lot more
I'd
for
be
your
paying
mortgage.
a lot more for my mortgage.
The point I'm making here is if people have $1 million in their 401k out there, tell me what the tax rate's going to be for a married couple, the top of the 12% tax bracket or the top of the whatever tax bracket is in 2035. You can't.
Yeah.
So that's why I liken a retirement account that hasn't been taxed to almost an adjustable rate mortgage. It's not something you want to tether yourself to, because the bottom line is that that account has never been taxed.
Right.
Someone will have to pay taxes on it, yes?
Yeah, absolutely. I mean, if you don't get to use up all that money during your lifetime, whoever is going to be the beneficiary of that account is going to end up having to pay those taxes. And a lot of times this is people's children who are still in their highest earning years. So it is a huge, huge burden on them. I mean, it's like, yes, it's very nice that you left, your nest egg to your children. That was very sweet of you. But did you really anticipate, or were you planning on them having to pay half of it back into taxes? Was that I don't think that's what most people are hoping for their children.
No. And in fact, yesterday, Rachel, one of our client concierge here, and I were starting the process of getting all the paperwork to have a new client come in. So we're collecting their information, got a copy of their driver's license, asked them, their social, and we're getting all this information collected. We're having them fill out their beneficiaries, and they had 3 kids. And I said, well, don't forget the 4th kid, Uncle Sam. And they just kind of looked at me like, what? Why?
He's like the stingiest one, too.
He is the stingiest.
Yeah.
Don't forget your Aunt Laura Kelly over there in the governor's office, too. But that's what Joshua says. I
Yeah.
stole that from him. But the problem here is that when people save for retirement, they save in mostly accounts that have not been taxed.
Right.
And someone will have to pay the tax on that money, whether it's them as a married couple, which is a more ideal time, because when you lose a spouse, your dollars in your tax bracket get cut in half.
Right. Yeah.
The top of the 12% for a married couple is $96,950.
Yeah.
And then the top of the 12% for a single person is like $48,000.
Yeah. It is cut in half. You lose half your standard deduction. I mean,
You're down a Social Security check when you lose a spouse.
Right.
And then you go tap those retirement accounts. And that's probably not the ideal time to be doing it. You should have been doing some Roth conversions, maybe
Right.
some reclassification
Yeah.
early on. But people don't normally realize that until it's kind of too late.
right.
But that's your job to help me with those
Yeah.
questions that we bring them in there.
I think a lot of people think that tax planning ends in your retirement, and I think tax planning is way more important once you get into retirement. A lot of times you have more opportunity to do things.
Well, and just like you wouldn't want all of your investments in one stock,
Right.
You want tax diversification
Yes.
too, just like you need investment diversification.
Absolutely.
And we help people do that every day here. And if you don't have someone that you can rely on, if you've got questions and you're approaching retirement, give us a call. 833-44-CORE4. That number again is 833-442-6734. Or you can hop on over to the website at retirementhelp.com and you check out blogs there. We're adding more classes you can watch on demand there. It's a great resource, retirementhelp.com. It's been a long project in the making of mine, finally getting it out there and starting to become what we want it. But we want it to be an educational resource to help you in retirement. Don't be like one of these stories we talk about on our TV show where people have made costly retirement mistakes and only find out about it afterwards. That's why you need to schedule that 15-minute call. And you can do so, again, by calling 833-44-CORE4 or hop on over to the website at retirementhelp.com. Well, that's all the time we have this week. You're getting warmed up to go in the TV studio with me here right after this, right?
Yep, sure am.
Going to make some movie magic in there.
Some movie magic.
That's all the time we have this week. We'll see you next week.
Investment advisory services are duly offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor, and Market Investment Group LLC, an SEC-registered investment advisor. The investment advisor representatives of Market are also affiliated with and registered through Foundations Investment Advisors LLC, and may provide services on behalf of both firms to client or prospective clients where properly licensed or exempt. This show is presented by Market Investment Group LLC, an SEC-registered investment advisor that only conducts business in jurisdictions where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. The firm is not engaged in the practice of law or accounting. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the show's publication and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this show is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities and other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. This is not endorsed by the U.S. government or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all your options. All client or prospective client names have been changed to protect the identities of the individuals discussed. All rights reserved.